Hello, everybody, and welcome to today's topic on the second part of the corporate structure. So on Monday, we have covered the ordinary type of companies or general companies. Today, we are going to focus on two different types of corporate structure, one of which is termed as a qualifying company, and the other one, which has become probably more important, is the look-through company. So I'll run through the qualifying company regime first, followed by the look-through company. So qualifying company, for these two types of companies that I'm going to look at today, they are an elective regime, right? Meaning that number one, the company must satisfy the criteria, because to become a qualifying company, there are a number of criteria they need to be satisfied. And once they satisfy the criteria, if they want to be a qualifying company, they actually have to make an election, right? Inform the Inland Revenue that they want to become a qualifying company, right? So that's what is meant by elective regime. It is not automatic. So even if a company satisfies all the criteria, it is not automatic. They must actually make the election. And of course, when it comes to making election, there are some of those housekeeping matters that they need to attend to, right? As to when they have to make election, what they have to do, so on and so forth. So anyway, for qualifying company, there are a number of different criteria. And on this slide, I've only shown two of them, right? Two, which I think most important, and we're just going to focus on this. But don't forget, as I mentioned, there are a few others, and you can read that up in the NZT book. So one of the criteria is that the company must be a New Zealand resident company. So foreign companies are not allowed to elect into this regime, because it is quite a favorable tax regime from a tax point of view. Another important criteria is that it is only open to a very small type of companies, right? So good examples will be family type companies. So they have restricted to a number of shareholders, and that is 5. So only companies which have 5 or fewer shareholders, right, will satisfy this criteria. And when we look up the number of shareholders, it has also pointed out very clearly that those who are associated with one another will be grouped together and counted as one. So afterwards, I'm going to run through 1 or 2 examples to see how we actually calculate the number of shareholders. Because if it exceeds 5, right, the qualifying company regime is totally out of question. Now, just to talk a little bit about the history behind this qualifying company regime, it was introduced many years ago. Can't remember exactly which year, but many, many years ago. And at that time, they also have a loss attributing qualifying regime in place as well, right? I just want to point this out to you. This loss attributing qualifying regime, the LAQC, is no more in place. So it has been repealed. And sometimes when you read some materials, particularly when you Google on the internet, you find out that some information about LAQC still pops up, right? So you should know by now that there is no such a regime available anymore, right? So we don't have any LAQC anymore. In the year about 2010, 2011, the government decided to revamp this regime and come up with another new regime. So what they offered those companies that elected into the QC regime to either stay as it is, or if not, choose some other business structure like in the case of partnership, right? They can move to those other structures without any sort of penalty. But if they don't want to move to other structure, they can remain as it is. But no new QCs are allowed anymore, right? So from 1 April 2011, companies, even though they satisfy these criteria, they cannot elect into a qualifying regime anymore, right? So, but we do have QCs still around because they want to remain as it is, and therefore the set of tax rules that applies to QC are still there within the Act. So you find that, well, this is about few years back statistics which I've shown you earlier, and it was very much later after they changed the rules. You find that we still have a lot of qualifying companies, right? Here's about 50,000 odd. And that tells us that a lot of these companies find that it is still advantageous, right? From a tax point of view, it is still advantageous to remain as a qualifying company. And I'll come to those advantages afterwards, right? So let's go move on to the next slide and have a look and see how we actually work out number of shareholders. So as I said, normally these shareholders are family type people, right? Family type companies. So I have a simple example here. If I have a father and mother and their 2 sons and 2 daughters, if they are shareholders in a company, let's say Law Limited, and the father's father is also a shareholder, right? We want to see whether this company is eligible to be a QC or not. So I've just drawn a diagram to illustrate that, showing you the shareholders in this company. In fact, I should call this Law Limited. Forgot to change this to Law Limited. And if we just look at number of shareholders, if we count the number, we actually have 1, 2, 3, 4, 5, 6, 7. We actually have 7 shareholders. And the criteria is 5 or fewer. And it says if they're associated with one another, they are actually counted as 1. So if we look at the father and mother, they will be associated with one another. This is a husband and wife. The father's father is within 1 degree of blood relationship, right? So the father, mother, father's father, they're all counted as 1. And the father's 2 sons and 2 daughters are also within 1 degree of blood relationship to the father, right? So that means when we apply the associated person rule, this whole lot, they are counted as 1 person, right? So therefore, it does satisfy this criteria. There are 5 or fewer shareholders. Now you notice that, I forgot to mention this earlier, you notice that we are using 1 degree of blood relationship. So it is a bit narrower, a much more closer relationship. When we look at associated person rules, most of the rules refers to 2 degrees of blood relationship. So when the government decided to revamp the associated person rules, they decided to standardize it and say we will only apply up to 2 degrees of blood relationship. Now, this qualifying company rule was implemented much earlier before they revamped the associated person rules, and that's why it still stays at 1 degree of blood relationship, right? So this is the one that uses 1 degree of blood relationship. So in this particular case, they will satisfy the 5 or fewer criteria, and therefore it can be a qualifying company. Now take note that I said earlier that from 2011 onwards, you cannot have new qualifying companies. But even then, for the existing qualifying companies, they must not breach the criteria. right? So even though they remain as QC because they were formed much earlier, if they change the number of shareholders to such an extent that there are more than 5 shareholders, then it will breach the criteria and it will no more be regarded as a qualifying company anymore. And therefore, they will not enjoy the advantages that is given to those QCs. All right, so do bear that in mind. Now, if we change the example a little bit, you'll find that here, what if the father is not a shareholder in the first place? So I've removed the father here. And again, don't forget that we are looking at up to 1 degree of blood relationship. And that means the mother and the son and daughter, the children will be within 1 degree of blood relationship with the mother. All right, so that is one counted as 1 shareholder. And then we have this lot, right? The father's father, which is counted as 1 shareholder, right? So all in, we will have 2 shareholders in this case, and it will still satisfy the 5 or fewer shareholder, right? So this is just to illustrate how we calculate the number of shareholders. And don't forget, for QC, it's only up to 1 degree of blood relationship. So what is so good about being a QC? Why do these companies still want to remain as QCs when they are allowed to opt out of it? Well, the advantages are here. Number 1, a very strong advantage is when dividends are distributed to the shareholders, if they have any imputation credits available, then they will have to attach those credits to the dividends. And therefore, when the shareholders receives those dividends, they're taxed on the gross dividend. And of course, they can claim the imputation credits, right? At the end of the day, whether they have to pay more tax or not really depends on their marginal tax rate. Now, the second part, if there are no imputation credits attached to the dividends, then the dividends become totally tax-free in the hands of the shareholder. Now, this is the part where the advantage is. Now, in the past, a lot of companies, there are property investment companies like to use QC. And in the past, because we don't have very stringent rules, where at that time, a lot of the bright line rules have not been introduced, right? You find that, and we don't have a capital gains tax rules in place. Companies that buy property as long-term investment, and later on, if they sell those property and make a capital gain, the capital gains are not taxable, right? So for those property investment company, if they are a qualifying company, and if they sell the property making a capital gain, they don't pay any corporate tax because the gains are not taxable. Now, if they don't pay corporate tax, it means that they don't have imputation credits to attach. And therefore, the dividends that they distribute to their shareholders becomes totally tax-free, right? So that is the beauty of remaining as QC, especially for those companies who are who owns investment properties and where those capital gains are not taxable. Of course, now the rules have become more stringent. We have a lot of different bright line rules to look at, and I will cover that next week. But even then, the most stringent bright line rule now we have is the 10-year rule, right? So companies can still retain the property for a 10-year period, and sell them after 10 years, right? And they can still not be taxed on the capital gain, and they can still distribute those capital gains tax-free, right? But again, bear in mind that no new QCs can be formed now, right? So I'm just talking about those existing ones, why they find that it is still beneficial for them to stay as they are. The other good point is, like this is the part, if they make any capital gains and when they distribute any capital gains, they are also tax-free, right? Remember when we did ordinary companies, if they distribute any capital gains, they are taxable in the hands of the shareholders. The only time when it is not taxable is when the company is being wound up, all right? So there is a bit of difference in tax treatment. And then this point about imputation credits, in most cases, they most likely will have no imputation credit balance, because if they have to use it up. But sometimes they might have. So if they do have, the rules are not so stringent on them. They don't have this requirement of a 66% continuity rule, which they have for the ordinary companies, right? So it doesn't matter if there's a change in shareholding, whatever balance they have in the imputation credit can still be carried forward to future years. Disadvantages. The disadvantages lies in they make the shareholders of a qualifying company personally liable for any tax that the qualifying company did not pay, right? So even though the company is a limited liability company, they have imposed this additional rule on shareholders for tax purposes, right? So shareholders of qualifying company are personally liable for any tax that the QC did not pay, right? Of course, if the QC pay the taxes, that's not a problem. But if they don't, the inland revenue can come after the individual shareholders for the share of the tax that's not paid by the QC. Compliance burden, compared to other structure, they will have to be careful that they don't breach any of the criteria, right? So they have to monitor that. So in terms of that, the compliance burden is there, right? Just to make sure that they have not breached those criteria. And of course, there are some housekeeping matters about election or re-election when there's a change in shareholding, right? Those part needs to be complied with as well. So that is about qualifying companies. I just didn't want to spend too much time on that because no new companies can become QC anymore. But as I said before, we have still quite a number of QCs around, and because they still enjoy those advantages that I've pointed out to you earlier, right? Particularly in terms of distributing dividends tax-free if there are no imputation credits attached. So when the government decided to do away with new QCs, what they did was they brought in a new regime, which they call the look-through companies. Now, the look-through companies operate in a very similar manner as a partnership, but only that look-through companies, well, it is a company. It enjoys limited liability status. So again, small businesses actually might like to elect into a LTC regime if they satisfy the requirements. So the requirement is very similar to the QC requirement. It's only open to companies which are resident in New Zealand. And again, they restrict the number of shareholders. It must be 5 or fewer as well. But in this particular case, we're looking at up to 2 degrees of blood relationship. Right? So let's go a little bit further. than the QC regime. And who can be a shareholder? It can be a natural person, that is a human being, all right? Sometimes trust might be a shareholder as well. So they will look at trustee of a trust. And in the case of company, an ordinary company cannot be a shareholder. It must be another look-through company. And they call it a look-through company because they're going to look at that company and look through that company to see who are actually the shareholders of their company. And then from there, they're going to count, right, how many shareholders there are to see whether they satisfy this 5 or fewer criteria. So again, I've just highlighted some of the main requirements. There are a few other conditions that must be satisfied before they can elect into the LTC regime. And for that, you can read up NZT chapter 15. Now, in the case of look-through companies, when they calculate the 5 or fewer shareholders, they actually term those shareholders as look-through counted owners, right? The owners are the shareholders. So those people are the look-through counted owners. They are the natural person, right? These are the human beings. In the case of a trust that is a shareholder, the counting is more complicated, right? And I don't want to go through that counting with you all in this course, but just bear in mind that the trustee of a trust can be a shareholder of a look-through company, only that the way they calculate the number of shareholders is more complicated, right? Because it's going to depend on whether distributions are made to beneficiaries or not. And they're not going to look at just this current year. They're going to look at the previous 3 years as well, just to make sure that the trustees doesn't manipulate in such a way that they distribute to beneficiaries in 1 year and don't distribute in another year, right? So they have this more strict rules where they extend by looking over a 4-year period, right? Whether distributions are being made or not. So we're not going to the details of calculation for trustee. We just focus on the one that refers to natural person. And this is an example of that. A simple example. Let's say, I haven't changed the name of the companies. I should change the name. Oh, sorry, this is the correct one. Yes, Delta owns 50% of XYZ Limited, and the other 50% is owned equally by her husband and 4 children, right? Children 1, 2, 3, 4. How many look-through owners are there? So we want to see whether XYZ Limited can elect into the look-through company regime. Now, when we look at the rules for QCs and LTCs, actually the percentages doesn't matter. They're actually looking just at numbers, right? So it is the number of shareholders that's important. For look-through company, it is the number of look-through owners that are important. So Delta and husband will be husband and wife, right? So they are associated with one another. And their 4 children, right, will also be within 2 degrees of blood relationship. So although we have 1, 2, 3, 4, 5, 6 owners, and because they're counted as one, we only have 1 look-through counted owner. And therefore, it satisfies this requirement of 5 or fewer shareholder under the natural person rule, right? So if XYZ Limited wants to elect into the LTC regime, they can do so, provided they satisfy all the other requirements as well. Now let's change the example a little bit. We have Delta that owns 40% of this company, and the other 60% is owned equally by her husband and the others. How many look-through owners are there? And we are told that C1 and C2 are actually Delta sisters. C3, C4, and C5 are actually Delta's friends, right? And you know that friends doesn't come under the associated person rules. They are totally each individual person. So we already have 1, 2, 3 owners here, right? They are each separate owner because they are not associated with anybody. If we look at Delta, Delta and her husband are associated with one another. And Delta's sister, they are within 2 degrees of blood relationship with Delta. And therefore, we can combine the sister Delta and Delta's husband, and that will be counted as 1 look-through owner, right? So we have 1, 2, 3, 4. We have 4 look-through counted owner, and therefore it satisfies this criteria of 5 or fewer. So again, if XYZ Limited wants to elect into the LTC regime, they can do so by inform the Inland Revenue, and of course, provided all the other conditions are satisfied as well. So how are these look-through companies taxed? This part is very similar to the partnership structure that I went through with you all. It actually look through the company and look at the individual owner. So any income of the company, it flows through to the owners based on their shareholding. Any expenses flows through to them. If there's any credit, they also get a share of that, right? And therefore, that means they will be taxed based on their marginal tax rate, just like for partnership. If the expenses are more than income, they actually get a share of the losses, and they can claim the losses against their other income. Now, when we look at the partnership, when we look at partnership and then we move on to a limited partnership, I did introduce to you all the loss limitation rules, right? And I did explain why we have the loss limitation rules. For the look-through company, when they first introduced this, they actually have similar loss limitation rules. But later on, they find out that it is too strict on the LTCs. It was removed, except for those who are in partnership or who are in joint ventures. So for those who are not in partnership with others or in joint venture, the loss limitation rules doesn't apply anymore, right? And we're just not going to get involved with this loss limitation rules because in most cases, it doesn't apply. Right, so that is the tax treatment. These are the main ones. And to just show you as an illustration that it is very similar to partnership, only that this is a company. If we have 2 shareholders and they're equal shareholders, and let's say the LTC income is 10,000 and the LTC deduction is 5,000, this income will flow through to each of the owners based on their profit sharing ratio, their shareholding. So in this case, it's 5,000 each, and the deduction will flow through to each of them, 50%, in this case, 2,500 each. And the net income for A is 2,500 as well as for B. So depending on what other income they have, right, it will just be taxed at their marginal tax rate. So in a sense, it is quite good, especially if they are at a low tax bracket. So sometimes it can be the other way around, where expenses are more than income. So again, the income will flow to the shareholders, half each in this case. Deductions will flow to them half each, and each one gets a loss of 2,500. And there's no restriction about claiming of losses. The losses can be used to set off against their other income. And this is the advantage, right? Especially for companies that are making losses because they have huge expenses which are deductible. So these losses can be set off against their other income. If they don't have any income in the current year, it can be set off against their income in the future years. A few other points about look-through company. Working owners. Now, in the case of partnership, I have mentioned that a partner who works in a partnership, and if they pay themselves a salary, the salary, they are not tax deductible because they're recognized as drawings. So similarly for look-through company, the owners, if they pay themselves salaries, those salaries are not tax deductible. But just like for partnership where we have working partner, for look-through company, they do recognize that sometimes the owner do really work in the company. So if they qualify as working owners, meaning that there must be a contract of employment reflecting the duties they do, etc. So if there is a genuine contract of employment, the worker, the owner is considered as a working owner. So in that sort of situation, if they pay a salary to the working owner, that salary is a tax deductible expense. Fringe benefit tax implication. Of course, if they employ other people in the company and they provide fringe benefit, right? The employer, which will be the look-through company, will have to pay FBT if none of those fringe benefits are exempt. But if the fringe benefits are provided to owners themselves, there is no FBT liability. And just like for working partners, the working owners are not recognized as employees for FBT purposes. Then deductions and income rules. We have covered general deduction rules that apply in the same manner as for look-through companies. What happens when the owner wants to exit the business? In a look-through company, for tax purposes, they are deemed to have sold their share of the underlying assets. And because of that, just like for partnership, it may trigger some income tax consequences, right? So they actually will have to compare with how much they receive from selling their share of the assets. If they receive a lot and the net amount that they get is substantial, then they will be taxed on those amount. But if the amount is considered as insubstantial, then they don't have to pay any tax. So how to decide whether it is substantial or not? We have this formula that they need to use to calculate to see whether their selling of their share of the business would trigger any income tax consequences or not. So you find that this formula is very similar to that of the partnership as well. All right, we're not going to calculate using this formula. This is just to make you aware that it may trigger income tax consequences depending on the sale proceeds that they receive. There are a few other exemptions available, and we're not going to cover that in this course. If you like, you can read up NZT. It might mention a few others apart from looking at the $50,000 threshold. Associated person rules for look-through companies. When I went through associated person rules, I didn't run through the part for LTC. So the rule for LTC is the LTC and the owner are associated with one another if the owner holds at least 25% interest. So here, if I have two owners of LTC, one actually has 30% shareholding and the other 70% shareholding, is satisfy this requirement, and therefore this owner is actually associated with the LTC, and so is this owner, right, who is also associated because they have at least 25% interest. Now, sometimes the owner doesn't hold that much of interest. It will be below 25%. If that's the case, it will be based on whether the owner is a director of the company. If the owner is a director of the company, that owner is associated with the LTC. Or if the owner is an employee, it will also be associated, right? So that's how the associated person rules apply to LTC. So that wraps up the QC regime and the LTC regime. You have noticed that we didn't go into a lot of detail, but just to introduce you to what are the tax implications in general that will apply if people or companies are under these two types of regime. So now I think, well, apart from that, you will have to go and read the New Zealand taxation book for all the other details, because I can't cover all of them here. But the most important ones, the most important points I've already highlighted in these slides. So now will be a good time to actually summarize them up. And I have this scorecard here where we can actually compare the three different types of companies and see how different they are or how similar they are, particularly from a tax point of view. All right, so let's run through them. So my first column is referring to ordinary companies, right? My second column, QC, stands for qualifying companies. And the third one stands for look-through company. So the first question is, let's have a look at liability. Does a company have a limited liability? Does a QC have limited liability? Does a look-through company have limited liability? If I guess correctly, I think you will all say yes for a company. Yep, companies have limited liability. Well, what about a QC and LTC? Do they also have limited liability? Well, companies comes under Companies Act, right? So for a company, they must have limited liability, isn't it? They do enjoy limited liability status. You notice that in the case of QC, I have put an asterisk there. That is just to look at from a tax point of view, because if you remember, when I went through one of the slides, I say that the shareholders of the QC are personally liable for the tax to be paid by the QC if the company did not pay, right? So the asterisk there. For tax purposes, there's no limited liability, right? The inland revenue can come after the shareholders if the QC did not pay their tax. What about losses? Can the losses flow through to the shareholders? Now, this is a criteria which owners of companies will be interested, because these losses are useful to them, right? It can be used to shelter their other income, especially if they have other income. We've gone through the losses rules for companies, and well, they have some conditions that needs to be satisfied. And a company and a person are two separate persons, and therefore you find that the losses cannot be passed down to the shareholders, right? And apart from that, they can carry forward the loss to other years, provided they satisfy the requirements. So stricter when it comes to claiming of losses for ordinary companies. Now, what about a qualifying company? If the QC make losses, can the losses be passed down to the shareholders? No, they can't, right? Because we don't have this loss attributing qualifying company regime anymore, right? So that is gone. So for a qualifying company, if they ever make losses, the losses will just be dealt with in the same manner as for an ordinary company. What about a look-through company? Does the losses flow through to the shareholders, right? And I think you all would assume you all would say, yes, we've just covered that. Because all the income flows through to the shareholders, all the expenses flow through to them, and therefore, in the event they get a loss, the loss is actually belonging to that shareholder, and therefore, right, it flows through to the shareholders, and they can use it to set off against other income. So it is a plus point for look-through companies. Sometimes people want to ask a question about what about raising funds, right? Is there more flexibility in raising funds in the form of debt or in the form of equity? And normally when we raise this point, we are actually comparing with other structures like a sole trader or a partnership. And corporate structure usually have more flexibility because they issue shares, right? And they can issue debentures as well. So they do have more flexibility in raising finances or funds. What about tax rate that apply? Is it the flat rate of 28%, or is it the progressive rate where we have 5 different rates that apply? So for a company, I think if I assume correctly, you all would say that it is a flat rate, all right? Only one rate, 28%. For a QC is like an ordinary company. So they are also taxed at a flat rate of 28%. A look-through company, because the income flows through to each one of them individually, they'll be taxed at their marginal tax rate, right? So it really depends on what other income they have. When distributions are made to shareholders, if the dividends are fully imputed, are they tax-free for an ordinary company? Well, when we covered this, we never talk about them being tax-free. They're actually taxable. Only that the imputation credits goes with them, and then the shareholder can claim the imputation credits to reduce their tax liability. That's all. What happens if capital gains are being distributed to shareholders? In the case of a company, they are not tax-free as well. It will only be tax-free when the company is being wound up. What about in the case of a QC? Well, this part is the part where QC has some advantages, particularly where there are no imputation credits attached. If there are full imputation credits attached, the treatment is the same as for companies. But if there are no imputation credits attached, it is totally tax-free. When capital gains are being distributed, they are also tax-free in the case of a QC. Now let's move on to LTCs. Are dividends tax-free? I've put 2 ticks there. Capital gains distribution tax-free, yes, and dividends tax-free. Actually, when you look at LTC, there's no dividend implication at all because it is actually looked through to the owner. The owner already gets a share of income, they get a share of expenses, and then they get taxed on the net amount. So later on, when distributions are made to them, from a tax point of view, those distributions are not taxable, right? Otherwise, they'll be taxed twice, right? So I just put a tick there. What happens when the owner wants to exit the business? Can they just sell the shares? Can they sell the assets? And for a company, ordinary company, they have a choice, right? But most of them will sell shares. It's so much easier. And for QCs, it is the same. They can sell shares or they can sell the assets. And I'm looking at from a tax point of view. For LTC, from a tax point of view, they are deemed to have sold a share of their underlying assets of that company, right? So therefore, you find that it might trigger income tax consequences. What about fringe benefit tax implication? And I'm looking at benefits provided to the owners themselves or to the shareholders who are employees. In the case of ordinary company, yes, there's FBT implication. In the case of QC, to owners who are just shareholders, there's no FBT implication. But if the owners who are also employees, there will be FBT implications. For a look-through company, again, to owners, there are no FBT implications. Right, so this part is specifically referring to owners, benefits to owners or to the shareholders. Income splitting opportunities, let's have a look. Yes, some income splitting opportunities, particularly when they bring in their relatives to help in the business. Similarly for QCs and for LTCs. So I have covered this part under also excessive remuneration, and I'll put an asterisk there just to take note that if the remuneration is excessive, the Inland Revenue has the right to adjust the amount that's been paid, right, to reflect the market value of remuneration. Compliance burden complex. And again, when we talk about complex, we're going to compare with other structures like sole traders and partnership. Generally, they are looked upon as more complex because they have more compliance obligations with the Companies Act, as well as with the Income Tax Act. All right, so just more or less just summarize the main points and the main comparisons that we are making between these three types of companies. Right, so the last bit I want to go through is going to topic 9, where we look at sole trader, partnership, and trading trust. We can also do the comparison, right? So I just run through this with you all. In terms of a limited liability, we're looking at a sole trader, and I'm just looking at general partnership, not a limited partnership, and we're looking at a trading trust, right? So is there any limited liability for a sole trader? And I think you all know this answer. They don't have limited liability. For a general partner, but I think you all know this as well. There's no limited liability. For a trading trust, there's no limited liability. It is not a separate legal person, right? So there's no limited liability. When it comes to claiming losses, right? These structures, well, most of these structures are more favorable. For a sole trader, if a sole trader makes a loss, if you remember, there were no other restrictions being imposed. So all the losses can be claimed by the sole trader against other income. In the case of a partner in a general partnership, there are also no other restriction. The other restriction only applies to limited partnership, right? And here we're just looking at general partnership. In the case of trading trusts, well, a little bit stricter. They do not allow them to pass the losses to the beneficiaries, right? So it can only be carried forward by the trust against their future years' income. In terms of raising finance, so with this, we're going to compare with the corporate structure. they don't issue shares, so less flexible in terms of raising, well, they can't raising debt, or they can't raise equity. What about tax rate that applies? In the case of sole trader, well, it goes to the individual sole trader. It will really depends on their marginal tax rate. Same with partnership. And in the case of trading trust, it really depends. If it remains as trustee income, it will be at a flat rate of 33%. If it goes to the beneficiaries, adult beneficiaries, it will depend on what is their marginal tax rate. So it can be progressive. What happens if the owner makes drawings from the business? From a tax point of view, there are no further tax implications, right? Meaning that there is no further layer of tax which is being imposed, unlike in the case of companies. The drawings are actually dividends. What about capital gains, right? Because the owner is the person who owns the business, right? There is no further tax when they access the capital gains. Exit strategy, well, of course, this shares will have it's not relevant because they don't have shares, all right? So it will just be by selling assets. And when they sell the assets of the business, depending on what sort of asset we're looking at and how much they receive from selling those assets, it may trigger some income tax consequences. FBT, what about benefits being provided to the owners or the beneficiary? There is no FBT on that. And this is referring to owners, it's not referring to other employees. Similarly, if it goes to a beneficiary, there's no further tax implication. What about income splitting? Yes, limited. If they can bring in the spouse or relative to work in the business. And normally when we compare the trading trust structure, because the trustees can distribute to beneficiaries who has a lower marginal tax rate, right? Then you find that they will be able to save more tax. So there are more income splitting opportunities under the trust than under the other two structures. Complex is the compliance burden complex. I guess we're comparing to the corporate structure is relatively straightforward. The trading trust is a little bit more complex, right? They just have to set it up carefully, draw up the trust deed carefully, and probably they should seek legal advice when they use a trading trust to run their business. So this more or less summarizes what we covered in topic 9. And I guess later on when you do your revision for exam purposes, I think these are two good charts to look at. All right. And in one of your activity question, there's also one that asks you to make the comparison. And I also have drawn up a table that actually compares the business structure as well. So you can go through that too. So that ends our topic 10. Next week, we have a very interesting topic, which we are going to look at properties, right? So the first part, we're going to deal with personal properties, which I will also talk a little bit about the KiwiSaver, which is more of the portfolio investment entity structure, the PI regime. And then on Thursday, we will have a look at bright line rules and what happens when they sell land, right? So that will be next week's topic. So does anybody have any questions at this stage? If no, we will stop here. No questions? All right, I will stop my recording now. Bye, everybody.